you want an exposure to a market or an
Everything they need in one place.
Be the world's foremost authority on
Individuals, advisors and institutions. Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and here with me today is Richard Buxton, manager of the Old Mutual UK Alpha Fund. Hello Richard.
Morning.
So I thought we'd start by looking at stock market prospects. We've had quite a few managers, including the sort of bearish Sebastian Lyons, saying, you know, get into defensive stuff now, the market's going to correct, US and UK both looking overvalued. Although it does continue to, use your phrase, grind up. We're higher than we were a year ago, 2 years ago, 3 years ago. Can this continue?
Yeah. Well, you're absolutely right that, you know, it's not a cheap market anymore. And, you know, 5 years ago, you could find all sorts of bargain basement shares, which, you know, is a lot harder today. But let's not forget, you know, we're still in this extraordinary elongated post-financial crisis recovery process. It is a multi-year phenomenon. Activity is still gradually improving. And as long as that is the case and profits are continuing to move ahead, I think any setback would only be a modest correction. I know there's an awful lot of investors who do have cash to invest. They're waiting for some setback. So, you know, perversely, any setback is very brief and temporary. So I think looking at the long term, you know, the 3-5 year outlook is still a pretty constructive one.
You say 3 to 5 years there. We've, of course, already had 5 years of rally. Some people think that a market lasts 5 years, so what's to say that this will continue?
It is precisely this point that this is not a normal economic cycle, which is typically around 5 to 7 years. And then, yes, as you get towards the end and the central banks are raising rates to calm down an overheating economy, well, you know, we're not overheating. All the academics suggest that post-financial crisis, you know, it's a kind of 15, 20-year healing process. So the fact that companies have got their balance sheets in good shape now, they're beginning to invest a little bit of M&A activity. You know, this is not a stage where they're yet going to start really janking interest rates up. You know, inflation is non-existent. So it feels more like a kind of mid-cycle to me, and so that's why the traditional 5-7 year, gosh, you know, it's time to be much more defensive. I think it's too early. I think that actually you can see, as long as activity is continuing, 2 steps forward, 1 step back to improve. You know, the UK economy is in good shape, the employment keeps rising, we're just beginning to see a little bit of wage growth, which is good. As long as we see this for the next several years, then actually we may not re-rate anymore, but if we can just get the profit growth and some good dividend growth, then the market can grind higher.
Looking then at the sort of near-term challenges, you mentioned interest rates there. Also, you know, in a month we've got the election. These sorts of things breed in uncertainty. Markets don't like uncertainty. Does this mean that it's going to create buying opportunities, or does this mean that people need to be wary?
Well, on interest rates, I've long felt that the Bank of England wouldn't begin to raise rates until well after the election, and seeing who was in charge and what the fiscal policies were likely to be. I still think it's far more likely that it's the US we must look to. I still think the US is in a stronger position. They're a year or two ahead of us in economic growth. And personally, I think, you know, it would be good if the Fed did gradually start to raise short rates, and then we can see if bond yields just sort of back up, you know, gently. You know, that might provide some modest correction. That would be a buying opportunity. On the election here, short term, it's clearly very difficult to call the outcome, and it may be that, as with the Scottish referendum, it's only literally as we get to the days ahead of it that the market has a bit of a wobble. To be honest, I think, you know, it hasn't affected the way I'm running the portfolio. Even if, you know, some of the more draconian measures of, you know, let's break up the banks, you know, we know, albeit there'll be a knee-jerk reaction on the day, that it's taken years to actually carve out TSB from Lloyds, Williams and Grins from RBS. So, you know, this is going to be a long process in which, you know, there's going to be lots of further sets of results and dividend announcements and so on. So I think, you know, knee-jerk reactions, yes, but I'm a very long-term investor. So it's a lot easier to say this because sterling has already weakened quite a lot against the very strong dollar. 150 is around PPP. We were up 172 last summer. So it's possible that sterling may weaken some more against the euro. But again, perversely, that's not bad news for UK companies doing business in Europe. So again, it's more likely that any electoral jitters will be felt initially through the currency rather than the stock market.
Richard, thank you very much. This is Emma Wall for Morningstar. Thank you for watching.